have some sort of together if you're waiting. Okay, let's go to page 654 and let's talk through some of these, okay? Again, what we have on the schedule, what I'd like you to do over the weekend, it's Friday, isn't it? What I'd like you to do over the weekend is pull out all your quizzes, pull out the 2 tests that you've done, and go through and find out what you don't know, right? Just in general. Just make yourself a little list that I'd like to work this, this, and this, and this. Okay? Don't do anything with them yet. Just do that. I think that's a good idea. Because we're going to start doing it right during next week. Okay? Or you can wait until after the test if you want, but there's a review for the final on Friday, and then there's an optional review session for the final on Friday afternoon. So it'd be a good idea if you knew what you wanted to do in those reviews. Does that make sense? So we'll just work on what you want. I don't care what we do. Whoever shows up will cover whatever stuff you want. And let's see. Today we're doing chapter 13 some more. On Monday we're reviewing for the test, and then Monday 3 to 5 we're going to be in here, I guess. Sound good? And then the test is Wednesday. It includes chapter 13. I told you that a few times, so don't leave that out. Okay, and the 50C, of course. And then we'll start reviewing for the final. Okay? So we'll just pound through whichever problems you want. Doesn't have to be quiz problems. I can make up stuff, right? So, where are you guys having trouble? What were the hardest things? The most recent stuff is harder. Some people think so. Some people think the most recent stuff wasn't too bad. It depends on what clicks for you, right? Are you guys all good with deferrals and accruals? You do them in your sleep? Actually, you probably are. We'll go back and we'll look at them, you know, and refresh it kind of. And, oh yeah, we've been doing that all along. Bonds, maybe? Bonds still paying. Statement of cash flows. Go back to property, plant, equipment, all that stuff. All the way back to. So, all right, good. Everybody's got idea what we're doing. Don't miss those classes. You really want. Okay, it really pays off. So you get to study anyway, right? So, good idea. And on the reviews, suit yourself. And whether or not you watch videos of it, again, suit yourself. Right? However you want to do this. Okay, anyway, so let's talk about these different ratios. Again, if you look at, let's see, if you look at page 644 and 645, and 646, 647, can you read? Right? Remember I said you could probably get sound out the words before we started the class? I bet you could. I bet you could read numbers before we started the class. But can you read financial statements now? I hope so, at some level, right? When you look at that, you know what these things are, don't you? You know what they're talking about. You know how those numbers got there. You know that all of them started with zero when they started the company, huh? They just accumulated all the economic activity over the life of the company. That's in the balance sheet, right? And then they started at zero on the income statement and the cash flow statement and, you know, did the new year, didn't they? Right? On the equity statement, they started at the beginning of the year and go to the end of the year, too. Right? Cash flow, equity, right? Same thing. Right? You guys know how to read this thing, don't you? Right? So, you know what? If you and I were working on the same account, same client maybe, right? Or on the same company, and we were going to analyze their financials and talk about what they should be doing, you know, what kind of decisions they should make going forward, right? With, you know, should we invest more in property, plant, and equipment? Is it paying off? What kind of returns are we getting? How do we encourage new stockholders to buy our stock? How do we get our interest rate as low as possible? All those kinds of things, right? You know, we're trying to run a business, right? How do we get things going? If we were to look, and we're giving advice to this client, say, right? If we were going to work on the same client, what I'd probably do is pull out the financial statements, and I'd read them for an hour. What would happen if you pulled out the financial statements and read them for an hour? How many questions would I have versus you? By the way, you don't have answers, you have questions. What about this? What about this? What are you doing here? What are you doing here? Why is this like this? Why is this like that? And you're outsider, right? They're running the business. But they know the answers to those questions. They just have to put them together. Okay, that's what you do as a consultant, right? And professional CPAs are consultants. That's what we do. We advise people. Okay, so you know, you'd look at those statements. I'd look at those statements. We go into the meeting with the client. How many questions would you have versus me? You'd have probably none. Now none, right? But even when you graduate with an accounting degree from this place or a finance degree from this place, the answer is still going to be pretty much none, right? But somebody with experience is going to have tons of questions. Luckily, you're going to be with them and you're going to learn from them, right? But here's something you can do for yourself, and this works extremely well now and early in your career. Calculate these ratios, and calculate them yourself. And then ask yourself, why is the ratio what it is? So you get a handful of ratios you really like. This is more than enough. I already told you that, right? I don't like the cash flows, I would use those, right? I read the statements and I kind of see these relationships just because I've looked at them so many times. And so does anybody with 5, 6, 7, 8 years of experience doing this, right? Out in the real world, right? That's working hard, progressing. Okay? With that much experience, you quit doing ratios. You quit calculating. If somebody hands you one, fine. Okay. You already knew about what it was anyway. Or if the numbers look funny, I might calculate a ratio, right? Gee, that looks like that looks different. I'll calculate a quick ratio, right? What's deteriorating here? You know, what's improving, what's deteriorating? So I might do it, but it's kind of after I read the statements. With you, what I'd suggest is you read the statements pretty quickly, right? And calculate a bunch of ratios, and now you read them seriously. And what I mean by that is you got the statement sitting there, you got your ratios sitting there, you calculate them so you know exactly how it was calculated, you know what went into it, and then ask yourself, why did it change year to year? Why are we so much different than another company, right? Why are we different than what I expected? Why am I different than what the budget would have suggested? You can calculate ratios based on the budget and then calculate ratios based on the actual. You can take a benchmark company and look at what their ratios are, right? You can calculate them for them. They have financial statements, right? And then you calculate your company and you look at why they're different and ask yourself, what's different? How come they're performing so well and we're performing so poorly, huh? You get the idea of this, you guys? This really, really works for you. Really works for you. So remember that when you go out there and you start your career, and don't be intimidated by financial statements. Read them, analyze them. This is analyzing a little bit, right? Just a little bit. Do that, and you'll go into the meeting, and when they do start asking questions, you're going to have a follow-on question. Or you're going to say, well, yeah, I saw that too, and I kind of thought it might be this. And then they can, the person with a lot of experience can laugh at you and say, oh, for Christ's sakes, it couldn't be that because look at this other ratio, right? And you'll learn. And by the way, they'll respect you because you have the guts to say something. Always remember that. I hope you got that out of this class. Have the guts to say something. If you never say anything, I tell you what, she's brilliant. You're brilliant. I know. They don't remember your scores, right? But anyway, right? She's brilliant. You're brilliant, right? You're both really nice people. You go to the meeting. I'm running the meeting. She talks. You don't. And she tells me all about the things that you discovered while you two were working together. But she's got the courage to speak. You don't. Who's going to get a raise? Who's going to get promoted? Don't let those loud. How many of you guys are kind of introverts? Anybody? You do those Myers-Briggs things or something? And anybody introverted here? Nobody's sort of on the introvert side of the scale. Yeah, a few of you. Okay, how many are extroverts? Go ahead. They're going to raise their hands real high. No, really? The rest of you don't know what you are.
Oh, maybe in the middle.
Oh, maybe in the middle. Yeah, boring. It's more fun. I'm 0 to 10 on the introvert scale. 0 extrovert, 10 introvert. I'm working here, you guys. I learned how to do this, and I'm quite comfortable doing it now because I've been doing it for years. But you know what? In a social setting, you know what I do? We went to the beer place, the church that they turned into a beer place. It's the best beer place in town if you don't mind spending $8, $9, $10, $12 for beer. Really good stuff. But they had this take over the tap thing where, now I can't even remember which brewery it was. It was a brewery up in Indiana. Took over the place, right? So they said, trouble thing. So everybody comes. So my wife and I were going to meet one of our former students. And used to work for my wife when she was in the director. Anyway, so we're all meeting. And she wanted to go there. She really likes beer. And it's a great place. It's a great place if you go in and nobody's there. You had to wait in a line to get a beer. People were drinking beer while they're waiting for their next beer. It's kind of like that. Just ridiculous. People swarming all over the place. I was miserable. There was no place you could go up and be by yourself and quietly drink your beer. Right? I am an introvert, you guys. And I told my wife, we're never going to one of those things again. Right? Never. Right? I hate derby, by the way. I like to go to the racetrack when no one is there. There's a few of us up in the stands. It's the same track. Horses are running around in a circle. You can bet if you want. They have the same hot dogs, right?
Why would anybody go when Derby's going on and pay a fortune so that you could be crammed in with thousands of people? I just described extrovert, didn't I? Those of you who are introverts, do you really want to go be crammed in? And it doesn't matter if you're an extrovert or introvert. What do you need to do? Act like an extrovert. Why? Not really, but you've got to talk. Why? Because 75% of the world's population are extroverts. Most of the people running companies are extroverts. Or you pretend you're not, at least. So you can talk to people and direct people and all that stuff, right? Okay. I used to go to meetings when I was in Tacoma, Washington, for the CPA firm. And there was a Bellarmine High School. I'm not kidding. It was the one Catholic high school in Tacoma, Washington. It's big. It's Bellarmine, right? Isn't that funny? Anyway, everybody in the CPA community that was at a high level had gone to Bellarmine. It was the one private school, right, in town. It was a really good school. So anyway, lots of them. So they'd get together, all these business people, and they would chat about their high school days. You know how much I cared about their high school days? I went to Gresham Union High School in Gresham, Oregon. Who cares, right? Nobody. Anybody from St. X or Trinity here? I'm sorry, I just offended your sensibilities, right? Nah, who cares? Yeah, anyway. This is the only town I've ever been in where people will tell you where they went to high school before they tell you where they went to college. Good for them. What incredible fundraising they're doing. That's all that's about, right? Is raising money. Look at the stadiums they have and stuff, right? It blows us away, doesn't it? Right? Yeah, great fundraising. Anyway. But anyway, they'd chat for a while. And then after about 5, 6, 7 minutes, I'd say, you know, I'm billing for this time. And they'd say, oh, God, jeez, you're going to make us work. And then I think they're talking. So you can sit there and say nothing, okay? Right? For 5, 6, 7 minutes, and as soon as you start working, you take over. Right? Because you got all the questions. Because you did all the analysis, guys, right? You prepared for the meeting. That's really, really critically important. We have a really strong accounting major right now who should have been invited to those national things I was telling you about and did not get invited. Because this individual is kind of quiet when she first meets people. Stop it. Used to be real quiet. Sit in the front row in the accounting class, the principal's class, and I had to make her yell at the top of her lungs. And now she's running the place. Right? I mean, she's really, really good. They all are going to want to hire her. But right now she's kind of quiet. Damn it. Don't do that. Please don't do that. Don't affect your career with that. But then what can you do if you want? Guess what I did yesterday? I didn't have to teach. You know how many people I talked to yesterday? Other than on email. You know how many I talked to? One. My wife was around. Oh, no, I talked to the dog, too. That's two, right? She's a human being. Okay? So, yeah, that's it. I don't think I even said hi to somebody as I was walking the dog. I might have walked by somebody and said, hi. Right, guys? That's enough. I'm not working for them. Okay? Got it? So do what you want. And by the way, if you're a chatty Cathy, which I can tell these guys are down here, you know, you ever hear that term, chatty Cathy? So anyway, if you're a chatty Cathy, you know, use it. But then shut up when you don't know what you're talking about. Oh, got it? Right? So, and don't be paranoid, just go for it. All right, anyway. So, by the way, could you do common size statements here? Horizontal analysis, vertical analysis. What's horizontal? I look at the change year to year, right, and calculate what percentage that is. Big deal. What's vertical analysis? I take sales, net sales, and divide it into each item down below it, and I find out what percentage each item is of sales. What's profit margin, you guys? Net earnings divided by sales. You're automatically doing it if you do vertical analysis, right? So horizontal across, vertical down, big deal, okay? By the way, if I'm comparing a company that has 100 million in sales to a company with 10 million in sales, might it be a good idea to convert it to percentages? Because the dollar amounts don't mean much. They're not very comparable, are they? Because one's real big and one's real small. But if you convert them to percentages, you can look at the relationship between them. What's cost of goods sold for each of those companies as a percent, not the total amount. That's all this is. It's just not a big deal, right? But it's really useful. Now that's vertical, right? What about horizontal going across? Would it be nice to know how much the percentage change was each year if you're comparing two different companies? How much we grew or shrank in different revenues and expenses. And you can do exactly the same thing on the balance sheet, okay? That's all this is. It's not a big deal. All right? So let's take a look.
these ratios over on page 654. What's return on equity? Here's a way to think about this. You guys know this? All the ratios relate to the statements, of course. Okay, most of them are balance sheet and income statement. If I am comparing the balance sheet to the balance sheet, I just use the most recent information year in. Okay? I don't see any reason to take an average. If I'm comparing the income statement to the income statement, of course I just use the full year, right? Which would be year end. And I can compare last year to this year to the year before by calculating each year independently. Everybody got the idea? Okay, so we can do that. All right? But if I'm comparing the income, listen to this one carefully, so if I'm comparing the income statement to the balance sheet, I want to take the year in for the income statement because I start at zero, right? My revenues, expenses, and net income therefore. So I use the year in from the income statement and I use the average from the balance sheet. Just in case, let's say I'm doing interest. You know, I got interest for the whole year. What if I start with no debt and at the end of the year I have a lot of debt? I really should use what? The weighted average of the debt, right? Divided into the interest. But it's better than nothing to take the beginning and the end of the year, add them together and divide by 2. So it's the average for the year. Get my drift on this? And you look at every single one of those ratios, that's what they did, okay? So you don't have to remember, you know, right? You don't have to remember where you use an average and where you don't. I'd only use the average for the balance sheet numbers when I'm comparing the income statement to the balance sheet. Otherwise, they're all year in, right? Most recent information. Okay, so what I'm doing here then, if they say return on equity, what do I mean? That's the return on this, isn't it? What do the equity holders get? What does it say? Net income divided by average stockholders' equity. That's on all the equity, right? Is that just the common stock? No, if you have preferred stock, they take some too, don't they? But it's simple. All you do for that is you would take what? Net income minus the preferred dividends, because that's what the preferred shareholders get, right? And that's what's left for the common shareholders. You divide it by the common shareholders' equity. Wow, this is easy, huh? So of course this thing is going to be this net income over here, because that's what the shareholders get, right? We already took the interest out, didn't we? Interest is out of the net income. And we're going to divide it by what? It's coming from the balance sheet, so what? Average equity, huh? So when we say average stockholders' equity, what do we mean, guys? What's stockholders' equity? Common stock, additional paid-in capital on common stock, and retained earnings, right? If there's preferred stock, you leave it in there too. Preferred stock and additional paid-in capital on that. Why would you leave it in there? Because it's part of the total equity. Everybody got the idea? Okay? They don't have return on common stock, do they? Well, we could do it real easy. So that's the formula. It's just no big deal. Oh, by the way, where do you get the net income? It's on the income statement. Where do you get the average stockholders' equity? Beginning and ending equity are in the balance sheet, right? Add them up, divide by 2. Rocket science, right? It's easy, really easy. By the way, each one of these ratios is pretty much worthless by itself. What you do is you do a bunch of them, and then you look at the relationships between them, and you look at them relative to other companies, and you try to figure out what's going on, okay? What's happening? Where's it going? Compare us to last year and see what changed, okay? Are we getting better or worse? Why? Okay, so why is the really important thing, and what can we do about it, right? Nobody cares what happened. Everybody cares what's going to happen. We talked about that last time, right? All right. If I wanted to make this to be return on common stock, though, return on the common shareholders' equity, guess what I do? I take the net income, subtract the preferred dividend, because that's what they get, and that's not an expense, is it, right? It's a dividend, and divide that by the average common shareholders' equity, which would just mean leave out the preferred stock and the additional paid-in capital on it. Big deal. You don't have to know that, but it really makes sense, doesn't it? It's not a big deal, is it? So I like that one better, by the way, if I have preferred stock. Because I know what preferred shareholders are getting. If they got a 5% dividend, they get 5% dividend, right? I want to know what's going on with common stock, probably. Okay, anyway. But you don't have to worry about that one. You know what? What's the return on debt? We don't call it that, but it is a return on debt. What is it? There's no such thing as ROD, okay? Nobody uses that. But what is return on debt? This is return on equity. I guess that's return on debt. And what's this one going to be? I made him mad. Silly. Okay, return on assets, right? What do you think, guys? What would you do?
Is that where like you buy a house and then like you gain money from the house purchase? Return on assets.
Yeah. But what would it be in a business? You don't just buy a house.
It would be
You
like
buy land, building, equipment, investments in other companies, all the assets you have. So what you make off all the assets? What's return on equity? So what you made off all the stock. What's return on debt? It's the interest. Right? What do you get if you invest in debt? What do you pay if you borrow money? Interest. Why do people loan you money? You want to earn interest. That's it. That's what they get. Okay? But here's one thing. When you look at that, the debt is going to be what? The cost of the debt is going to be what? This is going to be cost of debt. You're going to call it. It's going to be the interest rate times 1 minus the tax rate. And we're going to do this later, you guys. 211. Those of you go on. Interest times 1 minus the tax rate. Why? I deduct the interest on my tax return. What if I put $1 million of interest on my tax return and I'm in a 40% tax bracket? What happens to my taxes? Put $1 million on your tax return expense. Whatever's your income, taxable income, goes down by $1 million, right? So if I put $1 million of interest on my tax return, my income goes down by $1 million. If I'm in a 40% tax bracket, how much less taxes do I pay? $400,000, right? So what did it really cost me for the interest? Let's see, I paid $1 million of interest and then I saved $400,000 taxes. What did it cost me, everybody? $600,000. Everything's that way. If I pay a bonus to one of my employees, let's say I give somebody a $100,000 bonus and I'm in a 40% tax bracket, what did my taxes go down by? It's $100,000 expense. My taxes went down by 40. What did it cost me for the bonus? 60. There's nothing to this, okay? So let's say I'm paying 10% interest. If my interest is 10% and I have a 35% tax rate, what would you do? 10% times 1 minus 0.35, right? I'm paying 65% of the interest, aren't I? Who's paying the rest? The government, right? If I reduce taxes. You got it, guys? Okay, we're reducing our taxes, and it's fine. It's to encourage people to borrow money, right? That's why they let them deduct it. Why do they let you deduct the employees' salaries? To encourage you to hire people, right? Now, really, that's what it is. It's encouraging economic activity. We don't tax people on all their revenues. What do we tax people on? Their revenues less their expenses, right? That's it, okay? So any additional expense you have tax savings, okay? Oh, what about revenues, though? That's the good side, is they get tax benefits. What about revenues? If I earn another $1 million of revenues, what happens to me? Another $1 million of taxable income, and the government takes $400,000, 40% of it, I get $600,000, right? Everything's that way, okay? One of the major costs of doing business is what? Taxation, funding society, right? Of course, I don't know, UPS kind of likes having roads. You suppose? They like having police protection. They like having people enforcing the laws, right? You know. They even like having stop signs, stoplights. So people don't run into their trucks all the time, and the trucks don't run into people all the time. They suppose. Yeah, so, you know, we get the benefit of the tax dollars, too, if your business is forced, right? Yeah. It will cost you the benefit. Services you don't have to pay for yourself, right? Okay, anyway, so, you know, if you think about it, how about if on the debt, what would that be, by the way? 6.5%, right, guys? If this were 6.5%, and let's say my net income, let's have a net income here of, let's make it be $1 million, let's make it easy, okay? And then my average assets, or my average stockholders' equity, beginning plus ending, right? And then divide by 2. Let's say this is 5 million, right? 5 million here is the average. What would 1 million divided by 5 million be? That's all you have to do. What's return on equity? 20%? Could this happen? My debt's only 6.5%, but my equity is 20%? The answer is yes. How could it happen? What did this company do? Really important to get this, you guys. What did this company do? They borrowed money at 10%, but then they could put it on their tax return and get the tax benefit. 35% tax bracket for this company, right? What would you say? 6.5 is what the interest cost me. I borrowed money at 6.5%, and what did I do? I invested it at a higher percentage, right? Because after I paid the debt, I still got to keep 20% on my investment. How many of you would like to borrow money at 6.5% and earn at 20%? This is nice. This is called positive leverage. Positive means what? My return on my equity is more than my cost of the debt. But what if I borrow at this 6.5%, or let's make it worse. I borrow at 10%, huh? And I lose money. Now what's my tax bracket if I lose money? How much do they tax you if you lose money? 0, none. So now what's my cost for the interest if I don't get the tax benefit? Come on, you guys. It's 1 minus 0 tax bracket, right? 1 times the tax rate, or 1 times the interest rate. It'd be 10%, wouldn't it? If you don't get any tax break, you pay the 10%. Oh my. Now I borrowed at 10% because I lost money instead of 6.5. You got the idea? Losing money can just unravel things fast. Disasters. Right? You go bankrupt fast. Okay, so now I'm losing money, right? So I've got a 10% interest rate after tax because there's no tax. And I earned 5 on my assets. What's going to happen to me? My equity return is probably negative. Depends on how much debt and how much equity I have. And I'm going bankrupt fast. Got the idea? Okay, so that would be negative leverage, huh? Borrow money at 10%, invest at 5. What do you think? Bad strategy. By the way, do you do that on purpose? Of course not. You know how much the debt's going to cost you because you signed an agreement, right? You're taking the risk. They're not taking as much risk. Their risk is that you won't make enough for you to pay them back, right? Pay the interest and pay them back. What's your risk? That, plus you don't get anything, right? You have more risk, don't you? Right? Okay? So, that's negative leverage, right? Positive is I earn more than my cost of debt, right? Negative is I earn less. Big deal. In fact, that one ratio, financial leverage, return on equity minus return on assets. Return on assets over here is measuring that, okay? Well, how does this happen? I earn more. How much more? Let's calculate it, okay? What do I have to earn to have this 6.5 and that 20? What's the formula for return on assets, you guys? Net income plus what? It's this net income I have over here, right? In our case, it'd be 1 million, right? 1.0 is the net income. Plus what? Interest expense net of tax. You guys see it? Interest expense net of tax. And I don't know what my interest expense was. Okay. But what my interest expense is, interest here, times what? 1 minus the tax rate. If I add those two numbers together, right, I am going to get the amount that I earned on my assets, right? And so what would happen is I must have a higher number here, right, than the 6.5, but less than the 20.0. Make sense? It's got to be more. And we can calculate how much more. Okay? So I'll make a little more complex example, or not more complex, a little more realistic example, and we'll try it. Okay? So that's all we're doing. Once I know this, right, if I know any two of these, I could calculate the other one. Kind of cool. Okay? So what's positive leverage? Really important thing to get. Borrow cheap, earn high. Like it? On your assets. What's negative leverage? Just borrow high and earn less. You don't mean to do that. That's the risk, right? But it could happen. Of course, you expect to earn more. Expect to make money. Okay. What's high and low leverage? What do you think that might be? Leverage is like a lever. You're levering your returns, right? If I have positive leverage, the more I borrow, the better. Don't you suppose? Don't you think it's better if I borrow more? If I can borrow money at 5%, and I can invest at 10, how much should I borrow? I guess all the money in the world, right? Why wouldn't we? Because when you start borrowing more and more, what happens? interest rates, right? So you're not buying at 5 anymore, right? So you got the idea? And also you have to find ways to earn that 10%, right? What happens if you borrow more and more and you grow? You might not earn as much, right? You grow too fast. So you're trying to balance this thing, right? That makes sense? There's a lot to manage here, a lot of moving pieces, okay? And you're taking chances, you're betting. I kind of like gambling. I don't gamble at casinos because you lose. I don't gamble at the racetrack. I'll bet, what is it, $2 a race? $2, my wife always places bets, minimum. $2 a race on all the races. Sometimes we win, sometimes we lose. We've actually had times when it actually paid for my deer not out. Okay? Free day at the track. Never made any money, though. I don't go there thinking you're going to make money, right? Where do you gamble? At work. Really? With other people's money. Well, something wrong with it, right? That's what you gamble with. And it's a fair game. You might win. Or you might not. Right, you guys? I want to give you a pretty good tolerance for risk. If you are unwilling to take risk, you're not going to get any return. Right? You can earn less than inflation. You can take all the money that you work really hard for, you can put it in a savings account, and you can gradually become poorer and poorer and poorer and poorer because inflation will be higher than what you're earning. And so you can work really hard, accumulate wealth, and then give it to somebody else by investing it in something that doesn't return the market rate. Or you can take your earnings and you can be careful. I don't mean risk averse, I mean risk neutral, right? Because you make good investments, sound investments. You can also give it away by giving it to somebody, she promises me a 20% return. I think right now, if you promise me a 20% return on investment, you are gambling with my money. That's way too high. In our economy right now, if you earn 8%, you're doing really good. If you told me you got a deal that will pay me off 20% a year, much less, double my money in a year, right? And she's gambling with it. Either that or she's just stealing it from me, right? Conning me out of the money, right? She's going to take it and spend it on whatever and say, oh, gee, I'm sorry, I lost the money, right? I lost it the day I gave it to her, right? Not when she lost it. Okay. But are there investments, by the way, that do get a 20% return? Yes. What's the deal? They're rolling the dice a little, right? There's a pretty good probability you're going to lose it. You guys with me? Okay. All right. So let's try this. By the way, can you figure out how to do each of these? You got any idea that you just plug numbers in? Read what they say, right? Think about it, okay? So, more important to get you thinking. Okay, let's try another one. Okay, I got assets, liabilities, equity, revenue less expenses. Let's try this. This is 100,000. This is 400,000. That makes this 500,000. This is $60,000. Got the idea? Maybe that's 250. This is 190. There's my year. I got this. Okay, and before this there was tax, right? So I've got, let's say I've got interest and tax. The interest was 80,000, and my tax rate let's make it 40%. Sorry, math's easy. Okay. So if I have this situation, oh, and you know how much debt I have, don't I? If I have interest of 80,000. That's way too much. My interest is 8,000. My interest is, let's make it simple, 10,000. Okay? My interest is 10,000. So what's my interest rate? If I have 100 average debt, 10%, everybody agree with that? It'd be 10 divided by 100. Everybody agree? So my interest is 10. So what I would do is I would take the 10 interest and I would divide it by the 100, right? Yeah.
that gives me how much? 10%. That's where I got the 10%. Okay. But what about after tax? If I'm in a 40% tax bracket, what do you think? It's going to be times 1 minus 0.40, right? So it's going to only be 6%. Everybody agree? The interest itself would be what? If we do the other way around. Could I take the $10 of interest times 1 minus 0.40, 1 minus the tax rate, and get 6,000 of interest? 6,000 of interest on 100,000 is 6%. Got the idea? Okay. So what I've got then is an after-tax cost of debt of how much? What number do I have? 6%. Everybody see it? Okay. What would I do for my equity? I've got 400,000. Let's say that's the average equity, right? What do you think? They earn 60. What's their return? 60 divided by return on equity. What do we got? 60 divided by the average equity of 400, right? How much is that? 15%? Know what that is? What must be the case? I've got positive leverage, right? Now let's talk about how much leverage I have too. I have what? 1 part debt, 4 parts equity. This is a low-risk company. 25% liabilities is one way you could measure the leverage, or they measure leverage in years by return. Well, do they even have a leverage? Yeah, maybe they don't. They just have financial leverage percentage. The return on equity minus the return on assets. We'll get that one. Another way you could measure leverage, though, is you could say I've got 20% leverage. Say I have 80% equity, right, out of the 500. Or you could take the 100 and divide it by the 400 and say I have 25%. It's all kinds of different ways. Okay? You'll see those. Anyway, so what would I do for my return on assets? Let's return on assets. This is return on equity. This is cost of debt. Call it KD, by the way. Cost of debt. Okay, what's assets? Return on assets. What was the formula, everybody? Net income minus plus interest expense. Net of tax. Times 1 minus the tax rate, right? That's net of tax. All right, let's try it. What's my net income? 60. What did I say the interest was? 10. And a little example. Okay. And what's 1 minus the tax rate? 1 minus 0.4, right? So that was 6. So what do we have? That's all 66. Would you guys agree with that? Okay. This is 66. And then I'm going to divide it by what? Average assets. What's average assets? 500. Okay. Let's say that's the average. What's 500 into 66? Somebody want to do that for me? How much? 13% about? Real close? 13.2. 13.2. Okay, so what happened to this company? They borrowed money at what? 10%. Government paid 4%. We ended up paying 6, right? We invested at 13.2, and what do we get to keep? 15. The reason we don't earn an awful lot more at 15 than the 13.2 is because we didn't take very much risk. But we still got benefit of positive leverage. Okay? So let's look at this. What percent do I have debt and what percent do I have equity? Watch this. This is really cool, you guys. What percent do I have debt and what percent do I have equity? What do we say? This is 100% of itself, the assets, right? Liabilities are 20%, my simple little example, right? Equity is 80%, isn't it? Okay? So I've got 20%, 0.2 is debt, right? And I've got 0.8 is equity. Multiply those out. What's 0.6 times, or 6% times 0.2? This would be 1.2%, right? What's 15% times 0.8? Is that 12? Of course it is. What's 12 plus 1.2? 13.2. Ah!
What if I did a lot more leverage, though? Let's say I could still earn, let's say I could earn 13.2, and I'm still borrowing at 6%. Let's calculate what our return on equity would have to be, okay? Let's say that were the case, right? So what I'm willing to do now is I'm going to borrow a lot more money. Let's say instead I have 400,000 in liabilities and 400,000 in equity. How would that work? Okay? So my return on assets, let's say I could still maintain the 13.2. So I'm planning what I'm going to do with my company, huh? I can maintain the 13.2. I think my cost of debt after taxes is going to stay 6.0. I would like to know how much I'm going to earn. Only this time, I don't have 20% debt, right? What I'm going to do is I am going to have 50% debt. So that's a lot of leverage, right? 50-50. By the way, what if you had 90% debt, 10% equity? That's kind of high leverage, don't you think? You can go bankrupt fast, right? Okay, or you can make a fortune. You're taking risk, okay? So what I'd have is 50% of my assets are financed at 6%, right? Because 50% of my assets are liabilities, okay? And I'd have, so of course 100% is earning 13.2, right? And then this would be what? 50% is debt, but how much is my return on equity? And what you do is you solve for return on equity. Oh, got the idea? Solve for return on equity. So you could use any numbers. What does it have to be? What's 50% of 3% or 60%? 6%. It's 3, right? Plus some number equals 13.2%. What does that number have to be? Obviously, it's 10.2. But that's half of my rate of return, isn't it? Because 0.5 times some number is 10.2. What are these guys earning? 20.4%. Oh. Would you rather earn that? What did we have up here? 15%? Would you rather earn, or it's 12? What I lied. It was 15. Would you rather earn 15 or would you rather earn 20? Well, I'd take 20, wouldn't you? But that's because I accepted more leverage, right? What if I went for 80% leverage? Let's try that one real quick. We got a minute. Let's try 80%. If I think I get, now by the way, what do you still have to do if you go 80% leverage? You still have to get the same interest rate. Good luck, right? It's probably going to be going up. And you have to do what? Get the same return on assets. But if you could pull that off, right? You're really good at running this business. This is still going to be 13.2%. And that'll be 100% of my assets I'm earning it on, right? What did I say? 80% debt now? Okay, so let's go to 80%. It's going to cost me 6%. Plus 20% is going to cost me some amount, some percentage, right? Calculate the percentage, guys. What does it have to be? Okay, this is 13.2. Just simple math. This is what? What's 80% of 6? 4.8%. So what's left that we earn over here? What's 13.2 less 4.8? 8.4, is that what that is? It looks like less, but it's not, because remember, that's 8.4 is only what? 20%. So 20% times some number is 8.4. How would you get that number? Divide instead. What's 8.4 divided by 0.2? Believe this one. How much? 42%. You would earn 42% if you could pull that off. You see how people can make a lot of money? But what are they taking in this situation? 80% debt, lots of risk. What do you for sure have to pay? All the interest, right? What if you don't make 13.2? Oh my, right? You could be in really big trouble really fast. Got the idea? Okay. That's just a few ratios. I'll do some other ones in the other class. So if you want to listen to that, you can. Okay? You guys